The share of properties bought by landlords in London has more than halved, from a 17% in 2015 down to an all-time low of 8% this year alone. Compare this to the North East, where we're seeing figures of 25% of landlords purchasing properties this year alone. So what exactly is happening? Are landlords really fleeing the capital? But also, if this is true, what impact is this having on the rental market across the country? Now, on this video, we're going to be looking at what exactly is attracting buy-to-let investors to the north. Is London truly still a safe investment? But also, what are the major reasons influencing landlords' decisions today? Stay tuned. Properties in the Midlands and the North generally offer a better yield for you. So generally this is going to be around about 7%. However, if we look at the South East, typically that has been around about 4 to 5%. That being said, after COVID, I'm seeing yields that are going around about 5 to 6%, and that's for different reasons. Prices going down ever so slightly, but also those rental rates increasing. In fact, it's around about 25% increase over the course of the last couple of years. London especially seeing the biggest increase across the region. So prices in the north are generally also going to be much cheaper than London. If you look at a one-bed property, you could probably get away with a one-bed property around about £120,000, even less. Compare that to London, you're likely to get away with around about £300,000. This does a couple of things for landlords. Firstly, if you're new to the market and don't have a large pot of money, this can allow you to enter the buy-to-let market. Whereas if you were in London, you wouldn't be able to even buy a garage with that type of money. If you are a landlord who has a large pot of money, what you can do is spread your risk across 3 or 4 properties. And of course, risk and return is something that landlords and investors in general are always going to look at. And we have cities such as Burnley, Sutherland, Middlesbrough that can be purchased at a fraction of the price, and with those yields hitting around about 7%. Now, there is a reason why these cities become more attractive, and just in general in the north. Investments in infrastructure and in regeneration projects have really brought life into these northern cities. If we look at the project of the Northern Powerhouse alone, which should look to improve not only transport links, but also business environments and the overall livability. I mean, these developments can attract both tenants, investors, boosting the whole local property market. So if we go back to 2008 with the financial crisis, what we did see was prices being impacted across the UK, naturally. But in the north, we saw investment opportunities with lower prices and for the potential higher rental yield compared to the south. And with Manchester and Liverpool, the introduction of the high-speed rail project, HS2, aimed at improving connectivity between London, the Midlands, and the north. And of course, this project increased investors' interest across all of these regions. Looking at Media City UK, which opened its doors in 2011 in Salford, Greater Manchester, having tenants like BBC and also ITV, I was looking at prices around about 4 years ago here and prices where they are now. And for sure, those prices have increased substantially, so there's also opportunity of capital growth because the pandemic also influenced the trend of remote working. And of course, if you have rental properties here around about £3,000 and I'm a tenant and I can work in any part of the UK, and I'm seeing rental property prices in other cities in the UK at £800, and these are cities that are growing. Of course, they're never going to offer what London offers, but there's always going to be a compromise. Some people are willing to compromise. And of course, those rental demands in those regions have increased substantially. If you're finding this video helpful, hit that like button. It really keeps me motivated in shooting more of these videos for you. Let's look at what has always attracted buy-to-let investors all across the globe to the capital. I have one word: resilience. London has always had, historically, the best capital growth. And if we look back in 2008 with the financial crisis, we can see that London was the quickest city to recover. By far, in 2011, it had peaked well ahead of other parts of the UK. So London is always going to be a solid bet for capital appreciation. Here are a few other reasons if you're not convinced. London is a global financial hub, attracting investment from Asia, Europe, and the Americas. Not only that, but this international appeal boosts property values and ensures steady demand for high quality housing from expatriates, multi-million companies and affluent professionals. And that's exactly what you want as a buy-to-let investors. I mean, they're pulling in students from high-end universities, corporate, tourists, professionals, and this is going to ensure demand for rental properties throughout the whole year, keeping any void periods to a minimum. And of course, you have continued investment in infrastructure and development, such as the Crossrail project enhances connectivity and boosts property values in areas benefiting from improved transport links. The kind of development drives long-term property appreciation and demand. If you're a landlord watching this video, leave me a comment as to your experience in the capital. And of course, there are other forces playing a hand in influencing landlords' decisions to leave the capital, but also to leave the buy-to-let industry in general. But it is going to impact more the capital because of the price point. I'm going to throw a few out there. I'm not going to dive too deep. But one of them, of course, is taxes and the changes that has brought over the course of the last few years. That includes Section 24, stamp duty, but also the wear and tear allowance being changed. If we dive into regulatory changes, starting off with the tenant fee ban of 2019, had a huge impact in profitability for landlords and for agents for that matter. Energy performance certificate, the EPC, and the changes that brought. Also the EICR, the electrical standards for all buy-to-let investors, of course, keeping tenants safe. Financial market changes. After the financial crisis, of course, the government stepped in, and now buy-to-let investors have to adhere to stricter rules, but also the stress test and deposits are so much more larger than what they were previously. And that makes it so much easier for them to perhaps invest in elsewhere where property prices are at a lower bracket. And finally, economic factors. Now, the cost of living doesn't just impact tenants, it also impacts landlords. And of course, with inflation and cost rising, this includes contractors, suppliers, and even agents. And for sure, the mortgage hikes in the most recent years have had a huge impact on landlords, and especially those landlords who have higher debt, and those are going to be in the capital. And these costs have been partly absorbed by the increased rent of up to around about 25% in recent years. However, if you really want to find out about how landlords are being forced to raise rents, make sure you watch my video. How much truth is there that landlords are leaving London? Well, landlords are exiting the buy-to-let industry in general across the UK for several reasons, which ones I've already explained. However, if we look at if landlords are leaving the capital to go invest elsewhere, that's something that I'm personally, in the circle of landlords that I see, and I speak to landlords on a day-to-day basis, is not what I'm seeing. I'm certainly seeing a more diversification, but not selling up here in London to be able to go and invest somewhere else. And the other thing is, there is truth that there is money to be saved if you're a buy-to-let investor looking to buy a property up north in comparison to the south east. Let's use a scenario. So you have £500,000 in a pot and you want to invest this money. Now, if you look to the southeast in London, you can buy a property of £500,000. This is in a modern building, concierge, all the facilities that you can imagine. £500,000, and your rental income is going to be in the range of almost £3,000, £2,800, bringing it to around about £34,000. This type of building is going to have huge service charges. Let's take that away. It's around about £5,000, leaves you around about £29,000. Now, that £29,000 against the £500,000 purchase is going to leave you with almost 6% yield. You have one stamp duty to pay, you have one legal fee to pay, one mortgage broker to pay, one agent to pay. Let's look at an example in Derby. Property I saw, £160,000, it gives you an income of £800. Great. Around about 6% yield as well. You'd have to purchase 3 of those to spend your £500,000. That means 3 lots of legal fees, agent fees, mortgage broker, and so forth and so forth. Yes, one can argue, well, you've spread your risk. But what's more riskier? Investing up north or investing in the capital of London? So in a nutshell, there may be some landlords diversifying from London to other parts of the UK. other landlords entering the market who just can't make their numbers work in terms of the amount of deposit that they can put down for the very high prices in London. But I haven't seen any evidence, at least within the circle that I am in landlords, that landlords are wanting to sell up to just purchase up north.